They said there was no way you could walk into a bank, flash your digital wallet, and come out with the keys to a new home. But here we are, on the brink of a seismic shift in how America buys property, and it is rocking the foundations of traditional banking. That is the exact exclamation you might hear from skeptical real estate agents and financial advisors. Now that the United States Federal Housing Finance Agency has taken an unprecedented step toward officially recognizing cryptocurrencies in the process of mortgage underwriting, what really happened? Why did this sudden revelation spark a frenzy among potential homebuyers, investors, and even some longtime real estate moguls? Today we are going to dissect this unfolding drama, from the newly signed directive that might allow major mortgage underwriters to count verified crypto assets toward loan eligibility, to the ripple effect that could rattle the entire housing market and beyond. We will explore how this initiative addresses pervasive fears of volatility, what it means for borrowers who have been sitting on digital fortunes, and the real reason behind the Federal Housing Finance Agency's bold new stance. In this deep dive, we will examine how these proposals aim to legitimize crypto in an industry that has historically looked upon digital coins with more than a little suspicion. We will get into the reasoning behind the Federal Housing Finance Agency's move, the ways this could dramatically shift the paradigm of home buying, and the factors that are leaving some industry veterans riled up. And by the end, you will discover all the crucial details: the stressful balancing act of mitigating market volatility, the potential dream come true for those who have weathered crypto's ups and downs, plus a brand new era of mortgage rules that could make your digital wallet as critical as your checking account. But let us not get ahead of ourselves, because the real spark that ignited this controversy came from the surprising directive signed on June 25th by William Pulte, the director of the Federal Housing Finance Agency, which specifically calls for Fannie Mae and Freddie Mac, those two powerful government-sponsored enterprises that hold colossal sway in the mortgage market, to look seriously at a future where crypto is treated just like any other legitimate asset. Many skeptics are whispering, did we not see Fannie Mae and Freddie Mac treat crypto as little more than an obscure curiosity just a short while ago? Indeed, prior to this moment, official guidelines often demanded that any digital money be converted fully into United States dollars long before it could even be considered in a borrower's asset calculations. But Pulte's bold initiative might upend that routine. In fact, the official stance until now has been crystal clear. As recently as 2021, Freddie Mac stated outright that cryptocurrencies could not be included in the calculation of assets intended for a mortgage, except when borrowers went through the hassle of converting them to cash or its equivalent. At the time, this was seen as prudent financial stewardship. After all, digital currencies are notoriously volatile. A mere rumor or tweet can cause prices to balloon sky high one day or sink into the depths the next. Lenders' wariness about pinning the hopes of repayment on such fickle capital was, in many ways, not unfounded. Yet, the crypto landscape has matured, driven in part by more robust regulations and oversight of centralized exchanges. These developments loom large in the Federal Housing Finance Agency's directive, which decrees that only crypto assets held on United States regulated centralized exchanges operating under legal scrutiny can be counted for mortgage underwriting. This is a built-in safety valve of sorts, ensuring that unscrupulous or unverifiable tokens minted in murky corners of the digital world are not put on the same pedestal as more established assets. Nonetheless, a question still hovers. Will this be enough to safeguard lenders and keep the housing system stable? Or does this open a crack that could unleash yet another wave of financial speculation? Speaking of speculation, we have to talk about the seeds of this transformative move. Observers were intrigued when William Pulte dropped a hint earlier that same Monday regarding the Federal Housing Finance Agency's interest in exploring crypto as part of a borrower's overall asset evaluation. The tremors went through forums across the internet, with excited chatter that maybe, just maybe, a new era was dawning, one in which that substantial nest egg in Bitcoin or Ether might mean a ticket to your dream home. Soon after, Strategy's executive chairman, Michael Saylor, jumped at the chance to offer up his proprietary model for calculating creditworthiness based on Bitcoin assets. He promised an approach that takes into account all the complexities, like the potential for wild price swings, the need for robust collateral, and the wisdom of only lending for concise windows of time. Pulte's readiness to review that model was another sign that the Federal Housing Finance Agency was not treating this as a publicity stunt, but as a serious maneuver. The question on everyone's lips is, does this herald a real merging of the crypto universe with conventional mortgage underwriting, or is it just a small step full of hidden obstacles that might never see the light of day? Indeed, both Fannie Mae and Freddie Mac are directed to develop proposals that integrate these digital reserves into their risk assessments. But they must still run those plans by their respective boards of directors, and only then can they be sent to the Federal Housing Finance Agency for approval. And there is the rub. We all know how big institutions sometimes move at the speed of cold molasses when it comes to adopting new technology. Nobody is too surprised that the Federal Housing Finance Agency included guidelines for risk mitigation measures, adjustments for digital coin volatility, plus demands for appropriate risk-based modifications to the portion of reserves in crypto. But does the presence of these cautionary steps mean the entire plan could get bogged down in technicalities and never quite be implemented in a way that helps the average homebuyer? Or will the various boards see potential in broadening homeownership opportunities by letting crypto holders leverage those assets? One especially compelling factor is that there are potentially a large number of crypto enthusiasts who have done reasonably well for themselves over the past few years, braving the marketplace's dramatic peaks and troughs. They might look at the possibility of including their digital holdings as reserve funds and feel newly empowered to chase after a mortgage they used to think was out of reach. And that, of course, has ramifications for the entire housing market. If more buyers can qualify, might we see house prices inflate further than they already have? Or does the fortification of underwriting checks and balances keep runaway speculation in check? If you feel your heart thumping over these questions, that is completely understandable. Perhaps you are one of those individuals who dabbled in crypto early and is finally seeing a precedent that offers real practical benefits in the everyday world. Or maybe the idea that big institutions might start counting crypto on a par with dollars and bonds has you shaking your head in disbelief. Before we press on, here is a friendly reminder. If you find this topic vital for your financial future, or simply riveting because it captures this epic clash between old-school traditions and boundary-pushing innovation, show your support by taking a quick moment to like this segment. It encourages us to bring you more in-depth explorations whenever dramatic financial changes like this come roaring into view. Now, let us talk about what has been dubbed the unstoppable impetus of regulated integration. Over the past year or two, we have witnessed an acceleration of regulatory frameworks that attempt to tame the crypto frontier. The decimation of some unregulated and high-risk corners of the market has ironically increased mainstream acceptance of the more transparent, legitimate platforms. That is precisely why the Federal Housing Finance Agency's directive insists on verifying only those crypto assets that can be tracked on regulated exchanges. The shift is not merely technical, it is cultural. By insisting on regulated exchanges, the directive is pushing crypto usage further into a know-your-customer environment, effectively telling digital asset holders that if they want their tokens to be recognized, they need to be operating within the confines of recognized legal frameworks. It is very reminiscent of how personal finance migrated from chaotic to codified structures over centuries. Perhaps we are seeing that same evolution happen in a matter of years for crypto. With that said, we cannot ignore the potential for mistakes or miscalculations. Market volatility is not just a scary bedtime story. If the price of a major cryptocurrency nosedives, what does that do to a borrower's reserves right when the mortgage has to be paid? The Federal Housing Finance Agency's directive does include references to risk-based modifications, presumably meaning that if a borrower's assets are heavily concentrated in crypto, the prospective loan might come bundled with higher interest rates, stricter timelines, or additional collateral requirements. But we simply do not know how stringently or how creatively Fannie Mae and Freddie Mac plan to implement these measures. Will we see complicated sets of instructions for prospective borrowers, or a single clear standard that can be easily navigated? To get a deeper sense of how this might play out, it helps to examine how conventional underwriting typically works. Usually, your assets need to be considered stable and reliable for you to qualify for a mortgage. You need to illustrate that you can consistently pay your monthly installments. The inclusion of crypto is a radical twist. Instead of rummaging for leftover statements of your bank account or rummaging through piles of pay stubs, you might need to provide detailed transaction logs from a regulated crypto exchange. Verifiable ownership, A track record of non-suspicious transfers and evidence of actual liquidity could become just as standard as proving you have stable employment. Yet this vision remains more theoretical than guaranteed, pending the final thumbs up from the housing finance powers. And that takes us to an essential question. Who really wins if this becomes the norm? Motivated first-time homebuyers with decent crypto holdings see an obvious plus. They might finally open the door to a property they could not have financed otherwise. But large lenders also stand to gain as the pool of potential borrowers grows. However, some watchers worry about a scenario in which people overextend themselves, leveraging every last Bitcoin to get a dream home that might turn into a nightmare if the market swings in the wrong direction. The directive at least nods to this possibility by demanding robust risk assessments, yet the exact nature of these protective barriers remains uncertain. A key figure in all of this is Strategy's executive chairman, Michael Saylor, who famously led a push to bolster corporate balance sheets with Bitcoin. When he offered his company's BTC credit model, it sounded like a blueprint for mainstream institutions to get comfortable with crypto-based lending. The underlying message is that modern financial analysis can factor in volatility in ways that mitigate some of the meltdown scenarios. Could this approach become the new industry standard? Or is it too specialized, punting the burden on an algorithm that might or might not account for real-world catastrophes? Historically, bridging the gap between technology-savvy entrepreneurs and the often cautious world of federal regulation has been no walk in the park. The Federal Housing Finance Agency's invitation for Fannie Mae and Freddie Mac to explore crypto-based underwriting is a testament to a changing mindset, but it also invites skepticism. Where exactly are the holes in this new approach, and who might exploit them? The directive demands that the proposals be ready and submitted as soon as reasonably practical. The race is on to see how quickly these two mortgage giants can craft guidelines that do not simply dunk eager borrowers into a pit of confusion, and that truly strike the perfect balance between innovation and prudence. Larger repercussions loom as well. If major mortgage underwriters begin counting crypto as an asset, it might prompt other financial institutions, think credit card companies, auto loan servicers, or even personal lending platforms, to open the door to a similar approach. The idea that your digital coins, once scorned as intangible fluff, could soon become as good as money in the eyes of entire financial sectors could spark an entirely new wave of adoption. On the flip side, if the nascent proposals get rejected or heavily delayed, we might see disillusionment from the crypto community, who may conclude that traditional finance is still unwilling to truly welcome them into the fold. Just imagine the next year or two. Prospective homebuyers with large amounts of Ethereum, Litecoin, or even stablecoins stashed away, eagerly looking for that updated Fannie Mae or Freddie Mac form that includes a proud little checkbox for verified digital holdings. It is the stuff of excited social media posts, with some predicting the birth of an entirely new class of homeowners who might have once felt deliberately shut out of the system due to the intangible nature of their assets. Will that accelerate homeownership for a new breed of tech-savvy investor, or sideline those who do not dabble in the crypto realm? Time will tell. If you are enjoying these speculations and want even more thorough coverage, including interviews with financial experts, real estate agents, and perhaps even veteran crypto holders banging on the doors of local lenders, then do not hesitate to subscribe. That way, you will never miss a single update on this or any other intriguing transformation blazing through the financial landscape. Yes, you heard that right. A quick choice to subscribe helps us continue our pursuit of clarity and fact-based exploration. Of course, let us not forget that, despite all the hype, the directive is not a magic wand. Do not expect that tomorrow you can stroll up to every other lender in the neighborhood and proclaim your trove of digital tokens as your gilded path to a mortgage. The Federal Housing Finance Agency has mandated that Fannie Mae and Freddie Mac craft proposals, and these proposals must be scrutinized at their highest levels before final sign-off. Only then will the new guidelines trickle down into actual underwriting procedures that lenders across the country follow. The timeline is ambiguous, and in the slow-turning world of housing finance, as soon as reasonably practical could still mean months or even longer. Patience, tempered with a careful watch on official bulletins, might be the main virtue required of prospective borrowers for a while yet. Meanwhile, the anecdotal stories start pouring in. Are there would-be borrowers approaching their mortgage brokers, asking if they can plunk down a chunk of their crypto as reserves, only to be met with blank stares because the final green light has not yet arrived? Are real estate companies themselves scrambling to accommodate a new wave of clients who demand that they accept digital proof of funds? Indeed, the scenario is reminiscent of earlier controversies when lenders initially balked at more novel forms of income or unconventional assets, only to eventually realize that the world had moved forward and they needed to follow suit or risk losing ground. That might well be the greatest impetus behind the Federal Housing Finance Agency's prompt to adapt. It is an acknowledgement that ignoring crypto is no longer viable. The directive itself alludes to ensuring these assets can be verified and held on United States regulated centralized exchanges. This suggests that, in the eyes of regulators, a refined approach to digital assets may represent an acceptable expansion of what qualifies as part of a borrower's net worth. The built-in guardrails, along with the emphasis on verifiability, are intended to keep unscrupulous or dangerously unstable tokens from blowing up the entire process. We should not gloss over the bigger picture here. This is one more sign that crypto is stepping out from the edges and into the mainstream. To some, it is thrilling progress, possibly unlocking new forms of democratized finance. To others, it is fraught with worry, a whole new dimension of risk that might weigh heavily on a housing market that has already been under strain. Regulators, lenders, and borrowers are about to engage in a tango of caution and excitement. Some might try to exploit loopholes, while others might pave the way for a truly balanced system that recognizes the digital era's unstoppable forward march. Finally, the essential question remains: can you trust the system to incorporate crypto responsibly, or will we see a wave of half-baked guidelines that create confusion and chaos? The directive shows intention and opens doors, but the devil is in the details. Maybe we will witness a surge in demand from younger buyers who have never known a time without the internet, but who have never owned a house either. The silver lining: if done right, a more inclusive approach to assessing assets could facilitate broader access to mortgages for all sorts of folks who otherwise might have remained on the sidelines. The risk is that hasty implementations or overlooked vulnerabilities could rattle financial institutions, leaving them scrambling to cover shortfalls if the crypto market plunges at the wrong moment. With the proposals still in the drafting stage, all eyes are on Fannie Mae and Freddie Mac. The entire mortgage financing community is waiting to see new guidelines that address everything from acceptable coins to the ratio of stable reserves versus volatile assets. So, stay tuned, keep your wallet password safe, and prepare for the potential dawn of an utterly new synergy between the digital asset sphere and the centuries-old tradition of purchasing a home. Whichever way the verdict goes, it is a story you will not want to miss, because it could reimagine the shape of financial possibilities for millions of homeowners across the nation.